let's go over one that is going to be pretty similar, but has a slightly different way of submitting the balance explanations. So if we go here on our review of amortization for prepaids view, and I access this reconciliation, you can see that it shows pretty similar to what we were just reviewing before. The main difference here, it's going to be the way that we submit the balance explanations. And this is actually going to be a pretty good example of what you were discussing just before. So this one actually has some movements prior to November. So you can see that in October, the beginning balance or the ending balance of October was $1,050. That's what you see here. The movement was minus $150, resulting on an ending balance of 900. Okay, that's basically what you were seeing on the other one, that it only have net activity on that month. This is a use case that actually has prior data on it, and that's the way that is going to be displayed. But the main difference between this one and the other one is the way that the end user actually submitted the balance explanations. So if I come in here into my balance explanations, you can see that we got one that was called amortization schedule. If I click on it, the first thing that you will notice on the left side is that it has different fields for the end user to submit. Remember that the other one had like a type and it had other information for them to fill. This one is more like a straightforward. So that's how you can see that they can be customized. But what is more important and the main difference on this specific reconciliation is that instead of them just submitting the corresponding amount, what they did is that they created an amortization schedule for them to be able to automatically publish the amount that corresponds to that specific account. So you can see here that the original amount was $1,200, but then the ending amount is going to be 900. The reasoning behind this being 900 is because we created an amortization schedule that behaves in this case as a straight line, and it was amortized in 4 months. If I want to take a look at the schedule, you will see that in here, it will display how this is going to be, how the amortization is going to behave for this account. So in this case, I put that I have $1,200 and I'm going to do the amortization for 4 months. So you will see that as I use a straight line, it distributed evenly those 300 for me to get to 0 at the end of my amortization schedule. So think about this as the easiest way for you to prepare this specific reconciliation for future periods, because now the system will know that you are going to amortize 300 on the next period, resulting on that one being 600 when you check the next month reconciliation. And you can also create custom amortization schedules. So if I want to modify this, and let's say that we precisely got an outstanding amortization next month, I can always customize those for them to behave differently. Okay, so just for you to know, that's an option, and that basically simplifies a lot the way that you are going to prepare this reconciliation moving forward. Because let's say that you have a pretty clear understanding on how this account is going to behave in the future, you can always initially configure those amortization schedules, and that's going to simplify a lot because they will carry forward when you do the reconciliation next month. That's basically the main difference between this one and the other one. However, it's going to be really important for you to be aware that this one is still going to be an account analysis because I need to justify the full ending balance of this account. So this is still going to be an account analysis type of reconciliation. Then let's quickly see in this case, for example, for the example that I was giving you, we actually did upload an attachment when we were doing the balance explanations on the amortization schedule. That's why you see here that we have the attachment in this place. Then in here, I can also show you how the prior reconciliations will look like in here. And basically, what this will allow you to do is that if you want to review what was done on October 22, you can always come here into prior reconciliations and just click on that. And that will take you to the same account, but it's going to be the prior reconciliation for it. Okay, then you can see that in here, we got the instructions. So you can see that the instructions on this specific case is, okay, make sure that the amortization schedule is carrying forward the entries. Because as we create the amortization schedule, the idea is that those 600 for the next month are going to appear here. That's basically like a double check, okay? But that's how the instructions are going to display on the reconciliations. Then we got a different type. It's not that commonly used, but you have the possibility of use a different type of reconciliation that is going to be called variance analysis. And variance analysis is going to be basically an account analysis because you only have a single source in the system. But what you will need to explain or justify is not going to be the ending balance. It's just going to be the monthly movements of that account. So what is the system displaying here? It will show you the current period ending balance in November 22. So this is the value that you're getting from NetSuite. However, the last period ending balance was this value here, resulting in a monthly movement of this 1,000 in here. What I will need to justify in a variance analysis type of reconciliations is just going to be the difference between the 2 months, meaning the monthly movements. That's everything that I will need to explain. So it's pretty similar to account analysis. The main difference is going to be that one, it's going to ask me to justify the full ending balance. And this one is only going to ask me to justify the monthly movements of my account. Okay, does that make sense?
Yes, that makes sense.
Okay, so you can see that in here again, I got the possibility of submit a variance explanation. In this case, just going to be for the difference, but it's going to behave the same way. Okay, I have a list of fields that I created for this specific process of loading the explanations, and that's basically what you are seeing here. Okay, but you can see that everything else is basically the same thing. So we have covered two different types of reconciliations. We have covered the account analysis and we have covered the variance analysis, but there's going to be a third one. And the third one is going to be the one that you're going to use when you have two different data sources to compare. One example that I got for that is going to be here on this check TM view, and TM stands for transaction matching. So on this example that I'm about to show you, I'm going to cover two pieces. The first one is going to be the balance comparison type of reconciliations, but on top of that, we are going to add that additional layer that is going to be transaction matching. Okay, so we are going to review the two of them all together. When I open this view, the first thing that you will notice is that on this specific reconciliation, I actually have two different data sources. The left side being what is usually going to be NetSuite ERP. And then on the right side, if this is a bank, this is going to be the bank statement, for example. But you will need to think this like with every single process that the customer may have. So maybe it's not going to be a bank account. Maybe this is going to be, I don't know, something related to sales, or maybe they want to compare a specific balance against a different data source that they got. So think about a payment processor app or any external data source that they may have. One of the most common use cases is going to be for us to use transaction matching when we are intending to reconcile the bank transactions. That's basically it. And that's the example that I'm about to show you. So the first thing that you will notice is that I have an ending balance on my left side, and I also have a balance on my right side. I can click on my reconciliation and you can see that the layout changed slightly because I have two different data sources. When we deal with a balance comparison, the idea is that at the end of the exercise, the adjusted balance is going to be the same as the adjusted source system balance is going to be the same as the adjusted subsystem balance. So this needs to be the same as this, so we don't have any pending unexplained differences. On top of that, as I was mentioning, this is something that not only compares the balances, but it also uses the transaction matching utility. That basically means that we will have also the detail of the transactions. So I'm not only going to compare two different balances, as you can see here, I'm also using an additional layer, which are going to be the transactions. So for example, in account analysis and in variance analysis, we never discuss about transactions. It's just the ending balance. When we include transaction matching on the process, that's where the transactions matter, because those are actually the ones that are going to impact the ending adjusted balance that you see here. So when I open a balance comparison reconciliation that uses transaction matching, I will be able to click here on my matching button all the way up to the right. And that will actually take me to the transaction matching UI. This dashboard in here is going to be composed by every single unmatched transaction that I'm still pending to take action on. And then it will also show me some suggested matches that the system provided to me by using something that is going to be called auto match. And the auto match is basically the set of rules and criteria that you have identified in the past as the link between the two different data sources that you got in here. So let me explain to you an example of on what that means. The system on those suggested matches will already give you, okay, the comparison between the two sides, as you can see here. So in this case, what you got in here, the GL transaction lines is basically the transactions that are coming from NetSuite. And on the bank transaction side is going to be basically what you got on a bank statement. What you're intending to do here is going to be to compare your bank statement that is provided directly by the bank and compare that against what you actually registered on your Net2DRP. The idea behind this is to identify any possible missing transaction that you haven't uploaded in your Net2DRP. That's the whole purpose of this. So this is something that can be really time consuming depending on how big the amount of transactions are, but you will need to consider that not all the registers in Net2DRP are going to be a single register. So just to give you a quick example, the bank could send me, for example, I don't know, yeah, just a single amount. On the bank, it only shows as a single amount. But then you're registering that in NetSuite by customer. So let's say that you have 10 transactions in your NetSuite that correspond to a single transaction in the bank statement, but you still need to identify them. So the most powerful tool that NSAR offers is what we call the transaction matching engine that will allow you to, by using the criteria that I keep mentioning, to identify those transactions from both sides and match them. So the relationship of those rules can be pretty simple. So it can be a one-to-one match, such as the one that you are seeing here. I'm just identifying a single transaction from NetSuite against a single transaction on my bank. But it can get more complex. You can also create some rules that, for example, will match the case that I was mentioning before. I can match something that is 10 transactions on my NetSuite ERP against a single transaction on my bank statement. And those are going to be called many-to-one rules. You also have the possibility to create one-to-many rules or many-to-many rules, okay? But the idea is that this is going to be really, really helpful on those organizations that register a single transaction against multiple bank transactions or the opposite. Because it could be as simple as a relationship of two registers against one, but I have seen customers that have like 60 different transactions against a single one. And dealing with that in Excel is going to be something really, really complex because the amount of combinations can get factorial, let's say. Okay. So what the system is showing me here is that by applying that auto match process and triggering that auto match, the system was able to identify some of them by using the criteria that I applied. So in this case, it's like pretty straightforward. I can see, for example, that the amount is tied out to the penny, and the date is also tied out to what we got on the NetSuite side, meaning that the system thinks that they are basically the same transaction on both sides. What this will allow the customer to do is to basically make a double check on what the system is suggesting. But it's not the only way that the system can give you the output of the matching process. So the system actually has two ways of dealing with the possible matches. The first one is going to be by using these suggested matches. And the idea behind the suggested matches is that I propose you something that I think is reasonable as a match, and then I need someone else to confirm or deny that match process. Okay, so that's why you see here that you got the possibility of confirming this match, but maybe when I get into this one, I don't think this is accurate, so I can always just discard it. Okay, so you will need to think about those as the ones in which you maybe are confident on the criteria, but not that confident that you can make this to be automatically matched. So what is usually configuring the system is that you create really strong rules for those that are going to be directly confirmed, and then you create some criteria that might be a little bit more loose, so those are going to become suggested matches. That's the idea. So the idea is that the end user is going to come here, confirm that everything is tying out or not. Maybe you have an outstanding transaction that was included in here, so I can always just discard that. So it will be get rid of it in here. At the end of this exercise of confirming the suggested matches, there are going to be some that are going to be directly matched. So let me show you here quickly a report of everything that has been matched on that specific process. Okay. And here I also have the possibility to filter by the status. So you can see that in here, I already have plenty of confirmed matches. And I also have some suggested that those are going to be the ones that we were just reviewing before. Okay, like this. You see, in here, I can also confirm or deny a suggested match. But the whole idea is that after you have done this exercise of confirming and rejecting the suggested matches, what you are going to end up with is the list of all the pending transactions that you haven't been able to match by using the rules. That's basically it. So how can I address that specific piece? I can always go here into the unmatched transactions card on the left side, and this will basically display all of those pending transactions that I haven't been able to identify with my rules. Ideally, if we have really strong rules and we have a really strong process on the way that we're registering those transactions, we should be able to minimize the amount of outstanding transactions that we got left. But in the case that that happens, let's say that you have this specific invoice that took forever to be registered, so there's no way that we're going to include a rule that is like check as something that is the same amount, but it was like 3 months afterwards registered. That's where you will have those outstanding items. However, the system will still allow you to create those corresponding matches. So even if something was not picked up by by the system. I can always manually select in here from one side and the other side. You can see that all the way down, it will actually show me the variance between the two in case I want to be 100% sure that I'm tying those out to the penny. And then I can just click here and match, and they will become matched. Okay. The idea is that at the end of the exercise, you just keep in here those outstanding items that you haven't been able to identify, and you can always support them for you to be able to audit on them or report on them. So if there's this specific transaction that you know what is happening to it, you can always support it. So at least you register that there is a pending action item on NetSuite in order for us to get rid of it. That's the whole thing. All the changes that we're applying right now in here are going to be impacting this less unmatched and less matched in transit. Because as we keep removing transactions that we have identified, you're also going to review the less unmatched amounts that you got in here. Okay, that's really important. So you can see that right now we got, for example, $458,000 pending to be matched or to be explained. I can always come in here and let's identify a big one. So for example, we got this 300,000, and let's see if I have my equivalent on the right side. So I got it in here, the variance is 0. I can just match those two together, and that will have an instant impact on the remaining unmatched transactions that we got. That's the idea. Okay. However, at the end of the exercise, my goal is for me to make this difference to be 0, and that I don't have any pending unmatched transaction on my report. That will be the main goal. Okay. So I think in here we have covered the the most important, not the most important, the three types of reconciliations that we got. And also we cover how transaction matching gets involved on those balance comparison type of reconciliations. And that's it. I think that's it. That's it, Joaquin. Let me stop the recording because then I will need to edit it. Yeah, I don't know. You have